Senior Managing Partner, Kai Volatility Advisors, is on the line with us here this afternoon. Cem Karsan back on the show. Cem, welcome back. Okay, you have a complex way of looking at the market, but the very simple description of your macro framework I would describe is you were looking for the melt up over the last quarter, and then eventually that meltdown with the hawkish Fed. Did we just push out the meltdown a little bit here this week?
June OPEX, we got to start there. Why are we seeing this move all of a sudden? The scale, the size, the convexity, it's flows. It's the flows, stupid. I want to be clear. Quarterly OPEX, higher skew, vol pinned, going into the last 2 weeks in that window of kind of strength, right? Is a recipe, is all the perfect ingredients for that final squeeze. We hoped for it last month, but June OPEX is the perfect place to do it. And we've been looking for three things, right? We've talked about this ad nauseum. And it's the reason last month when we were on, we were very adamant. You're like, do you short this here? I said, no, but what you do is you buy calls, you sell stock. Why did I say that? Why did I say buy calls, sell stock? Because I said the next move will be market up, vol up, fixed strike vol up. And that is exactly what we've seen. 2 months out, today straddles in August are up $10 in the S&P 500. They have, the further out you go, that vol is just too low. You're sliding to too low a vol, especially given the realized vol. And guess what? You're seeing what you see in these blow-off tops, faster, quicker moves as you squeeze out the shorts. We've been looking for three things. I've been very adamant, three things that you need to see for that blow off top to finally play out. One, changes in sentiment and positioning. Guess what?
We got it.
I just heard you guys talking about it all makes sense. The market should be up. No offense, Joe J. Everybody's saying the same thing, right? The NVIDIA move, it all makes sense, right? Like the market should be up. Yeah, that's not what people were saying 10% ago, right? We've rallied 7% almost in 2 weeks. We are up in 2.5 to 3 months. We are up now 16, 17%. The whole way the Fed has begun to be hawkish. The whole way liquidity which is the lifeblood of markets, has gotten worse. You talked about Europe, you talked about Asia, you talked about Australia, and how they have a lot more work to do, and they are now pivoting to being more hawkish. Yes. There's about, everything made sense based on your conversation just earlier, but the one thing that didn't make sense is Jay Powell was really hawkish, but yields are down. These types of divergences matter. Don't lose sight of the ball. Don't lose sight of what is actually happening under the hood. Three things: sentiment, positioning change in. One, just more potential realized vol as you push this thing higher, right? We are now, like I said, 7% higher than 2 weeks ago. That is pulling something off the ground that can be increasingly dangerous, especially based on valuations and liquidity and the macro realities. But lastly, vol up. Vol supply is becoming unpinned. Calls, all the call short interest, people wrote calls against all their stock, all the selling of vol that's been happening. It is now being squeezed out by stock replacement, how cheap these calls are. There's a fundamental basis for vol bid out there, and guess what? You're seeing it. We're seeing big block orders coming in, buying vol in all kinds of different parts of the distribution. Vol in dealers' hands is no longer pinned. It is quickly moving away from that place, and that is a dangerous recipe.
Two parts.
Like I said, long call, short stock, and increasingly as we get through June OPEX here, you can begin to become more aggressive against that gamma that you've had in the portfolio.
Buy calls, short stocks, that's the position you feel like makes sense here until we get those three signs of peaking, correct?
It is what made sense. It is what has made sense as we get into this, this point of the rally. It is time to start layering more shorts.
Two things I want to come back on that we talked about and that you talked about here. Firstly, because I remember you used the word dangerous for the window of May, that there are kind of some structural things that kind of support that sell in May idea. How come that didn't take over that small period?
Yeah, and to be clear, the way you do this is you don't, this is not long or short. You don't just go in there and short the market, right? This is why we were very adamant about long call short stock,
Yep.
right?
You said dip the toe.
You own the part of the distribution that is undervalued to take those gamma shots. And there are windows, as we talked about ad nauseum here, where you take those. But when they pass, you do not fight windows. And not surprisingly here, as we go into June OPEX, and you're in a squeeze, right, with vol going up, this is a time to wait and look for the opportunity. And that's what we're doing.
Got it.
That said, right, the opportunity is here. We are in the Thursday leading up to the hours into AM OPEX tomorrow morning.
Cem,
so you decide whether or not this is a good window or not.
The Fed description, because I know an important part of that macro framework is that the Fed will still be aggressive. And I think I heard you earlier describe it as hawkish, and they really wanted to have this hawkish spin. But how can we take it seriously that they are going to get more aggressive later on if they push up their terminal rate at the same time as skipping a hike? It's almost like they are saying they're willing to let inflation fester. So how can we describe that as hawkish?
I think this is at the core of the misunderstanding and the miscommunication, honestly, from the Fed. The Fed was put in a very tough position here with a bank tail run in March, followed by a debt ceiling potential crisis, right? If neither of those things were there, I think it's fair to say they would have continued to be hawkish, just like they were before the bank run started. They did an abrupt pivot because they had a window that they needed to wait and see if a tail, which is not long or short the market, right? The left tail we've talked about, right? They came and relieved that left tail because they had to, because they felt there was existential risk. 15%, 17% higher in the market. There is no bank run happening, and inflation has been stickier from a core perspective. Employment, obviously, the last two employment numbers have been very hot. They have trotted everybody and their husband and wife out to express some level of hawkishness. The markets are not listening. Obviously, again, today, yields are down. The market is not listening. And that is something that they yesterday tried to pin down with the dot plot and try to sell calls to the market. The thrust in this several days, given June OPEX, given the gamma squeeze in all these AI names, given the stress, which is what we're seeing, by the way, this rally, and this is what you see at the end, is stressful to shorts, right? This is not a healthy rally. And that stress to the upside, that amount of speculation is not what the Fed wants. Right when we're starting to see several liquidity drains really come to fruition. So again, laying out the landscape, laying out the short-term flows. The landscape and the macro doesn't play out over days or weeks or even months, right? That plays out over years, quarters and years, but the flows play out over weeks and months. And so the flows are dominant in the short term. That's what's driving this. But the macro liquidity, the realities of what's happening here are quite out of step.
Cem, to the last point on our list of things to monitor, your third one, vol up, stocks up. Can you give me a quick 30-second explanation for how we want to measure vol up to the extent to where it becomes problematic or indicative, maybe rather is the word?
Yeah, there's a pretty straightforward way to do it. Go find what the at the money is today, right now, in the S&P 500.
Okay.
Go look at that option, find its implied vol. Go look at where that implied vol of that specific strike was yesterday.
Fixed strike vol.
Where was it yesterday? That is fixed strike vol. Look at it across expirations, and that'll give you, convert it to dollars if you want, keep it in vol if you want, but that'll tell you what's happening to implied volatility underneath the surface. Not what the VIX is telling you, but underneath the surface, and that's what's
wonderful.
Critical.
Awesome. All right, man. Thank you, Cem Karsan, for the update
Always
to the
enjoy
framework.
it.
Appreciate it. Okay.
Take care.
Buying calls and selling stock is the way to dabble in anticipation of a more meaningful rollover. Watch Fixed Strike Vol, Cem Karsan from Kai Volatility Advisors.